Good evening, everybody. You're welcome to today's class. I welcome you to the second part of this week's class, where we'll be talking about some of the trading terminologies and also we'll be looking into the technical aspect of the financial trading. So, for the course of those of other persons that want them to join this class, we'll be giving ourselves we'll be starting the class in the next 10 minutes. Let us give those that are not here the time to join the class. But for the purpose of people that are already here, if you can hear me, kindly signify in the comment section. If you can hear me in this class, kindly signify in the comment section so that we know that we are good. Hello, I'm seeing like five persons in this class, and I'm not getting any response. Okay, Harmony, thank you, Mr. Joshua. Please give us some time, like in the next 10 minutes we'll be back, like by 18:10, like 10 minutes after 10. Okay, let's reduce it to 5. We'll be back by 7 minutes past 6 p.m. Okay. Hello, good evening, everyone. We're so sorry that we had to start the class like five minutes later. So for everybody that had patience with us, we are grateful about that. We are grateful for that, I mean to say. So just like I said, we are going to be starting our class today with trading terminologies. And my colleague is going to talk about the financial trading proper, technical trading, I mean to say. So, and for this class, we'll be saying almost everything that you need to know. There are terms in trading. So that when someone tells you what is spread, you know. When someone tells you what is leverage, you should know. When someone tells you what is this, you should know that. So this is what the beginning part of this class is all about. Please, if you are hearing me in this class, kindly signify so that we'll start in earnest. And we can share the material for these lessons, please. You can go online, you can enter our YouTube, go to our YouTube channel. This class, as is live on Zoom, is also live on our YouTube channel. So after the class, the recorded version will be on the YouTube channel. So you can always go back there to check, or you can attend our physical class if you must. Buy buy the manual that we sell there, you know, for you to be able to enjoy what we've taught you and go back home to still remember them. Okay, thank you to Harmony and Joshua for always sticking with me since the beginning of this class. So we're going to be starting the class in earnest. So the first thing we are going to be looking at is pips, tick size, and points. So these are ways of describing a change in price assets or in asset prices. The use of these terms depends upon the market being discussed and the amount of price change in question. So we're going to be looking at this information and how they are going to be of good use to us in the market. So now in rally trade, we do not use ticks, but we use pips and we use points. And pips is short for points in percentage or percentage in points. Now it is a standardized unit used as a measure of change in currency pair. It can be measured in terms of quote or base. And mind you, it's not only in currency pair, it is in all instruments, whether commodities. I am sure we attended yesterday's class. We know that we have currencies, we have commodities, and we have indices. So it is used to measure the change in a currency. It used to measure the change in the pair or in the instrument you're talking about. So in regards to currencies, it's used to measure the change in a currency pair. And how do I liken these pips to our daily life? Like for example, now maybe yesterday you went to black market and the price of naira to dollar was 750, and today you go to the market and the price of naira to dollar switched up to 80. So that movement can also be called the percentage in points of that particular currency pair. So a pip movement occurs each time the fourth decimal place of a price moves by 1. For example, if Euro USD moves from 1.3243 to 1.13253, you know that there is 1 pip movement, and that is there is 10. We know that there is 10 points that moved. 10 points, you understand? Because 10 points is equal to 1 pip. We know these points is percentage in points or points in percentage. But really, we have brokers that are 4-digit brokers. Then we also have brokers that are 5-digit brokers. So rally trade as a 5-digit broker now offer fractional peak prices, which means that a fifth decimal place is often quoted. So instead of seeing 1.1324 like you see in other broker, you see 1.13243. And the change occurs on the fourth one. Like for example, there is 1 pip movement if price moves from 1.1324 to 1.1325. And there is half a pip or 5 points or pipette if price moves from 1.13240 to 1.13245. See, all these things I'm saying is just for you to understand what pip and point is and how it can move in the market. You understand? Now, pips and points. 10 points equals to 1 pip. 100 points equal to 10 pips. 1,000 points equal to 100 pips. So how many points do you think will be in 27 pips? Kindly keep your write your answer for me in the comment section. I didn't get any response. So how many points is equal to 27 pips? 270. Very nice. Very nice. Thank you for participating. So now we'll leave there and we'll move on to the next, which is leverage. So because this market is the global financial market that does transaction in thousands daily. Sorry about the break in transmission. Yes. So now, for every normal person, we know that the global financial market, we have over thousands or billions of transactions in a day that people transact. And when you want to trade now, you will not be asking, what is my naira to the global financial market? So when you see somebody coming to the market with 1 million naira, how much do you think 1 million naira is? How much is 1 million naira in dollar? It's small money. And for the market to recognize you as an intraday trader who trades for him or herself, you need to have what we call leverage. Is this leverage that increases your money, like multiplies your fund? Like, for example, brokers give you see brokers giving leverage between 1:200 to 1:700, 500, or some even up to 1:1000. It's just that even when your leverage is up to 1:1000, it's still not to your own good. We'll get to that later. So now, rally trade gives you a leverage of 1 to 500. And what does the leverage do for you? The leverage multiplies your trade, your deposit. Like, for example, you fund 100,000 naira and you open our real account, MetaTrader 4 real account, you will get 1 to 500. That means your deposit is multiplied with by 500. And when it's multiplied, is the amount of money you get after multiplication that the market is seeing you that you came with. It's not with the 100,000 naira or with the 1 million naira that you came with. So leverage is like a borrowed fund to increase one trading position beyond what would be available for their cash balance alone. Because even in normal trading, with 1 million naira, you can trade more than someone that came with 100,000 naira. And that's because your margin will be wide. You have more free margin than someone that has 100,000 naira. So that is what the leverage does for you. The leverage with your 100,000 naira will show the market like we have 1 million. So normally with 100,000 naira, you can't even enter 0.01 of Euro USD with 100,000 naira without the leverage. So the leverage now makes you to control more money that you would have controlled normally with the small money that you came with. So the leverage, just like I was saying, leverage, however, can amplify both profits as well as loss. Leverage can make you make more profit, and leverage can also make you make more loss. So now, just like I already said this part, leverage, our MT for the leverage is 1:500. S station leverage is 1:1000. And you see, just like I said, meaning that it gives you the opportunity to trade 200 times your deposit amount in MT4 for a huge profit. So what is margin? Margin is like, you know, anybody that knows my voice, I don't think I've told people my name in this space before, but anybody that recognizes my voice, because I believe that I have a very unique one, where I don't really have the ladylike voice. So anybody that know me over time know that I don't like reading plenty English in this class, because I believe that using life examples to explain things is a lot better. So now, what is margin? Now, margin is like you're going to the bank to borrow money for your business. And for you to borrow that money from the bank needs to hold something against you, that if they don't see you or if they don't hear from you, they will do what? They will carry their money back. You understand? And what is that? If the bank does not see you, what would they do? They will take your collateral. So that is what margin is in the market. Margin is like collateral. For you to enter this particular trade, you must have to have this particular amount of money kept. You must have to have this particular amount of money kept. That is the work of margin. So the margin is the amount of money that you need to keep in order to place and maintain a particular trading position. You understand? So it is not a transaction cost, rather a security deposit, just like the collateral that you give bank. Security deposit, it is not a transaction cost. It means that whenever you close your trade, the market will return your margin to you. Margin trading offers greater profit potential than traditional trading, but also greater risk. So now, if you're using margin, it means that if they're taking margin, it means that your free margin will reduce. So the amount of money that you still have to trade more will have to come down. But even at that, he also checks you. He also checks you, because he makes you aware that, oh, it's not everything I can trade. I will have to try as much as I can. See, these are the things I cannot do, because I need to put down my money for margin. So if you want to trade a lot of things, you need to do what? Come with a bigger trading capital. So this is how the margin is. So this is how the margin is. So margin is automatically calculated and assigned or added to the margin section on your trading terminal. Once you execute a trade order, look out for its corresponding margin in the section as indicated by the arrow above. So whatever trade, so now for these trades that this person has running, see the amount of margin that they have to give the market pending when they come. And look at how much the person has 536,000. And with all the trade they have, their margin is 47,000 naira. So what is free margin? So free margin is the amount of money that you still have in your trading capital or your trading account, I mean to say, which you can use to trade more. You can use free margin to enter more trade. You understand? So now, if you check your balance, your margin, if you minus your margin from your equity, you will now see free margin. Before I get to the equity, I will tell you what equity is. So free margin is the amount of money that you have in your account that you are free to use to enter more trades. So margin level is how healthy your account is. Margin level shows whether your account is healthy or your account has kidney failure. Whenever your margin level gets to 50%, you will have what we call margin call. And how do your margin level get to that level? You find out that you are entering a lot of trades. You see somebody having over 100 trades on an account of 1 million naira. Why? 0.01, you see somebody having up to 20 trades on an account, because before you know, your account will enter margin call. And margin call is trying to warn you that your account is about to blow. So it's from margin level that you know when your account enters margin call. And when it enters margin call, you start seeing your account blinking red. Your account will be blinking red. It means that you are on a margin call. And when it gets to margin call, the market will automatically close off the highest negative that you have. The market will automatically close off the highest negative that you have. So how do you get this margin level? Divide the equity with the used margin, divided by, like, the equity divided by used margin multiplied by 100, you get your margin level. So what is equity? The equity shows the true nature of your account at every particular time. You see that your balance doesn't change until you close a trade. If you're entering a trade, whether you are in loss or in gain or in profit, your balance does not change if you don't close that trade. You understand? But your equity will show the true nature of the equity will show the true nature of your account, taking cognizance of your running trade. Like now, if you enter a trade and you are in loss, your equity will be less than your balance. If you're entering a trade and you're in profit, your equity will be higher than your balance. So the equity shows the true nature of your account. That is what the equity shows. So let me go back to that slide that I jumped. So what is the difference between the margin and the leverage? It's very simple. Margin is the amount of money you are required to keep to open a position, while leverage multiplies the exposure of your account. Like leverage multiplies your account and gives your account more exposure and more opportunity to make more money. So note, the lower your leverage, the higher the margin, which is the reason why we give you 1:500 for you to trade. So another thing is when someone says, oh, I have drawdown, and you might be wondering, what's drawdown again? What are they saying? What's drawdown? It's simple. Drawdown is the total negative that you have. Don't mind the negative profits. It's the total negative you have in the profit section. Obviously, when you have a drawdown, when you look at the top or at the left-hand side or at the bottom of your chart, see now this person is in profit. So the person doesn't have any drawdown. You understand? But see this particular nigga now. This nigga is in loss. So there is drawdown. You will see that when you add these two negative, you get this money. When you add these two, you get this one. So drawdown is your trade. If you're on a loss, the total amount you are losing, is regarded as drawdown. Okay, and again, when you are in drawdown can also mean when you are about to enter a trade, and your trade will first of all go to negative before it will go to profit. That is the first definition of drawdown first, before we now start going to when the trade stays in negative for a long time. So now you enter a trade. The first thing that you do is to pay spread. So that first drawdown that you are going to get before you get to your profit, which is the reason why they say negative profit, because even if it's showing you negative, within the next seconds, you should be in profit unless the trade goes against you. Like, for example, you are on a buy trade and you enter a buy trade and you first of all have the drawdown for the spread, and the trade starts selling. You are going to continue to stay in that drawdown. Now we have the bid and the ask price. The ask price is called the buyer's price, and the bid price is called the seller's price. So this is the price at which a trader can buy an instrument, whereas the bid price is the price at which a trader can sell. So the ask price is always on top of the bid price, because the bid price is seller's price. So he wants the market to sell. So anybody that enters at the bid price wants the market to sell. So that's why the bid price is always below the ask price. If you have take profit and stop loss on your trade, it is the bid price that will close your buy trade, and the ask price will close your sell trades at those targets. Bear this in mind. Buyers and sellers price. So why do you need to know about ask and bid price? You need to know because the difference in the ask and the bid price is what we call spread. Okay, now see how the ask price and the bid price, see how it is on the laptop, and this is how it is on the on the phone. Okay. So now, when I call a client, I'll be like, come and fund your account, come and trade on with Rally Trade. You're going to make more. The next thing that will ask me is, what does Rally Trade stand to gain when I trade? And what do I tell them? I'll tell them that there is what we call spread. I have clients that they will fund their account, they will not trade. I wonder why. It's not like this is a bank. Because if you leave your money in the bank like that, they will continue cutting charges. But here, because you know that nobody is going to cut your money, you leave it here and go your way. So spread is the amount of money you pay to your broker for providing that services to you, for providing that brokerage services to you. So the spread is the difference between the bid and the ask price. The difference between the bid and the ask price. So on the laptop, this is how it is. This particular lane is the lane of spread. And spread varies from one instrument to another as much as it varies from one type of account to another type. You know, we have three different types of account. We have basic account, we have standard account, and we have pro account. And the best account for every normal trader should be standard account, because in standard account, you have floating spread. Now the spread can be, and now this spread that is 16 is 1.6 pips. So 1 pips, 1.6, that's 1 pips, 6 points. So in standard account, the spread floats. You can see spread 16 now, you can see it 12, you can see it 8. You understand? And most traders in the world prefers to trade on low spread instruments. And that is why I tell people to come and trade in Rally Trade. Because it's only in Rally Trade that you can see commodities and indices with low spread. And those are the instruments that give you more money. Currencies are also low, but all those other ones are lower, a lot lower than it. You understand? And because it floats, so you can see any small trade, any small spread anytime. So now on the phone, this is your spread. Just look under the instrument. This is your spread. If you're not seeing your spread, click on the MT4 at the top left of your screen. On the menu, select and click on settings, then scroll and select on advanced mode. When you are done, exit the menu and you see your spread. So, different types of trading. We have two main types of trading. We have the bull and the bear in trading. So we know that the bear is a predatory animal that hunts with hands to press down in a bid to conquer from bottom to top, to top, obviously. So the bear will drag you from your bottom and drag you down. So when a bear wants to attack, it will use his head and start from your leg because it wants to push you down. So whereas a bull is the one that starts from the top and drag you down. No, I think I mistook that. So the bull drags you from down and drags you up. You see a bull hanging people with his horn, whereas a bear drags you from up and drag you down. I think I've gotten it now. So simply put, all these bull and bear, they are confusing me. A bear market is one in which prices are heading down, whereas a bull market is used to describe conditions in which prices are rising. So that's the reason why they put bull and bear, because the bull will drag you from your leg and take you up. The bear will drag you from up and bring you down. Yes, that is the correct explanation. So that is why the seller's market, they call it a bearish market, whereas the buyer's market is called a bullish market. So now, you, just like I was explaining, see what they've said: long and short position. So long position is also called as a buy. Long is buy or bull, short is bear. Okay, so long positions and short positions are terms used to describe buy and sell trade in the market. A buy trade is a long position, while a sell trade is a short positions. So we have market orders in the market. We have market orders. We have two different types of market orders. We have instant / market orders, and we have pending orders. So the instant or the market orders, we also call it market execution or instant execution. So these trades, this is when you enter the market immediately and you want to take your profits. You want to enter. You already analyze the market, I mean to say, and when you are done analyzing, instead of waiting and say, let me wait, you just want, okay, my analysis augurs well with what I want to do. Let me just enter. You just, you enter. So this is how instant execution is. So when you click on new order, you see buy by market, sell by market. So you can just click any one and you enter immediately. So the second type is the pending order. We have 4 basic types of pending order. We have the buy limit, the sell limit, we have the buy stop, and the sell stop. So how do you use sell limit or buy limit? Buy limit is when the market is already, the market is going down. For example, the market is going up, I mean to say. The market is going up and is buying, but you came late because you are told that you're supposed to buy at a low and sell at a high. So the market is going up already, but you don't want to enter at that time. So you are waiting for the market to retrace back. That means you want the market to sell down small before you now enter your buy. So it means that you will make more money than someone that entered at that moment that he saw the market going up. So buy limit is the market is already buying, but you want the market to retrace a bit before it will start going up again. So you now, as it retraces, you enter your buy. So you put your entry at that place where you want the buy limit to trigger. So pending orders there, you are going to put it and you go, and later it will trigger by itself and close you out. So the same thing with sell limit is that the market is already selling, but you feel that price is already far. You want price to come up a bit, like buy a bit, enter your sell, and then start selling again. With that, you make more money. Then buy stop. Buy stop is the market is buying, but you don't have so much courage that this market will continue buying. What do you do? You say that you want the market to get to a particular level before you can enter your buy. So you buy higher than the current market price. Buy stop is when you want to buy higher than the current market price. Sell stop is when you want to buy below the current market price. Sell stop is the market is selling already, but what do you want to do? You want the market to sell a bit, like sell more, to be sure that this sell is really happening before you can enter your sell. So buy limit, you are buying above. Buy limit, you are buying below the market price. Below the market price, buy limit, below the market price. Sell limit. Sell limit, you are selling above the market price. Buy stop, you are buying above the market price. Sell stop, you are selling below the market price. So everything I've said there, if today is your first time of hearing it, it will confuse you. But what do? Go back and read on it. Go on YouTube, go on Google. Don't just use your phone to watch Instagram and watch movies on YouTube. Go to Google. That's why they say Google is your friend. Go and browse pending orders, and so that you get the information better. Or you can call your account manager, or at the end of this class, you can ask your questions if you didn't get that. So now we set targets with the market, we stop loss, and we take profits. So when you are using your pending order or even normal trade, you can set what we call your take profits, so that you can go your business and the market will close you out by itself. So how do you set your take profit? So what is even a take profit? Is when you set a take profit price on your trade, the price is automatically logged in on your broker server as the price you wish to close the market in profit if price moves in your favor. So it means that you already entered a trade, And you're hoping that if price moves in your favor, they should close you out. Close you out in profit. Emphasis on in profit. That means when the price moves in your favor and gets to your take profit, it will close you out. So now this is an illustration. This is where this person entered a buy. So they're hoping that the market is going to go up and give them profit at 200 pips. So at 200 pips, what will happen? The market will close you out and give you your profit. So take profit is aimed at to maximize reward. Whereas stop loss is saying that when you are on a trade and you don't want to keep on looking at it. So you want to leave. But you are aware of what we call risk reward ratio. You're not among those people that only look at their reward, they're not looking at their risk. You are thinking, as much as I already have stop loss, what if this trade goes against me? What will I do? So you set your stop loss that, and your stop loss is always advised that your stop loss is half of what you plan to gain in take profits. Half of what you plan to gain in take profits. So your stop loss should be below your entry if you're on a buy. Your stop loss should be what? Below your entry if you're on a buy. Your stop loss should be below your entry if you are on a buy. So you're saying that peradventure the market goes against me, please close me out here so that I will not lose more. That is what stop loss is. So the stop loss and the take profits rule. On a buy trade, your stop loss your take profit should be a price higher than your entry price. Why your stop loss price? Why your stop loss price should be a price below the entry price. This is an example. Your take profit on a buy should be higher than your entry. Your stop loss on a buy should be lower than your entry. On a sell trade, your take profit should be a price lower than your entry, because when you are selling, you expect the market to go down for you to make profits. You expect the market to do or to go down for you to make profits. So I'm almost to the end of this my class. So if you have any question, please type it so I will just answer it before my colleague will come and take the second class. So your stop loss, you want your take profit on a sell. You want the market to sell down so that you can make money. So your take profit should be lower than your entry for a sell, whereas your stop loss should be higher than your entry for a sell. Because for a sell, if your price is going up again, it means that it's not buying. So it should close you up at that moment. So now we have what we call trailing stop. Unlike stop loss, which remains at a set price on a broker server, trailing stop is a risk management tool that trails your trade at a preset distance in pips when price moves in your favor on the chart. Please, if you have any question regarding this my class, this is my last slide for this class, kindly write it in the comment section so that I will respond to it before my colleague comes. So how does trailing stop work? Let's say that you enter a trade and it goes in your favor, but you know that technically looking at this market that is going to move more. Like you're on a trade and you believe that the market is still going to move up more, but you can't stay and watch that trade. What do? You put trailing stop. So when you put trailing stop, it means that if you put 50 points as trailing stop, it means that at 20 point something, at 2.5 pips, sorry, 5 pips, I mean 50.5 pips, it means that you are following the market, your profit is following the market 5 pips behind. So your trailing stop will not be dragging you. If the market continues going in your favor, the trailing stop will start moving, will be moving and be giving you more profits. But immediately the market goes against you 5 pips, that is 50 points. What will happen? The trailing stop will close you out. If the market goes against you 5 pips, the trailing stop will do what? Will close you off. If you do 100, it means that when the market goes against you 10 pips, the trailing stop will move you out of the market. It means that you can never close that trade in loss. That's what trailing stop does. That's why it's called risk management too. You can never close that trade in loss. What happens is that it must be it's either you close it, you must close it higher or lower than you left the profit. But in loss, no, cannot happen. So this is what we said in this class. We talked about trading platform. We talked about spread, points, equity, margin, free margin, margin level, market orders, leverage. So as I didn't see any question, my colleague will continue with the second part of the questions. Just like I said before, you can't get this material. You can go to our YouTube channel and listen to this class again after the class. The recorded version will be up in our YouTube channel. Thank you.
All right, good evening. So we continue with the class. So I'll be talking about the technical analysis of the training. We're looking into the technical analysis proper. Okay. Hope if you can hear me, please can I see your message? Can you drop some messages for me to be sure that you can actually hear me? All right. So here we'll be talking about what technical analysis is all about, the price chart types, then some of the emphasis on the candlestick charts, then probably look at the supports and resistance. So what we're actually going to be discussing in this particular module is all about how to technically analyze a trade and be able to, do the trading properly and come out successfully. During trading, there are different 3 types of ways you can actually analyze the market and be able to do your trading. Number 1 is fundamental analysis. The second one is technical analysis. Then we'll also have the sentimental analysis, which actually comes out because of the fundamentals and some of the sentiments surrounding the market as at that time. So today, we are going to be looking at the technical analysis. So here, technical analysis is actually, it has different meanings to different people, but in a layman's term, it can call technical analysis as a trading discipline employed to evaluate markets in order to identify some trading opportunities by analyzing the statistical data gathered from the past activities of price. So analyzing the technical analysis can also be said as the study of past market action in order to be able to predict the future market direction. So looking at a chart, you can be able to tell that, okay, look at some things have happened, the price actions that have already taken place in the chart, some things have already happened. You can categorically say that, okay, this might actually happen or this might actually occur again. You know, history, there are sometimes we say history can actually repeat itself, you know. So technically analyzing it properly on the chart, analyzing the candlestick patterns, you know, the price actions, how it has been moving, everything that needs to be done, and also looking at it in different time frames and be able to have a close and overview look on what is actually happening currently in that market. This is aside from fundamental analysis. So that is what technical analysis is actually, that's what it means. So when you're analyzing technically, there are some of the uses, the things you need to know. So technical analysis can be used to generate a short-term and a long-term trading signals with various charting tools. So here, technically, when you are analyzing a chart, it can actually give you, you can be able to generate a short-term trading signal. That's for people who want to scalp or probably take an opportunity in that market at that particular point in time. So with technical analysis, you can be able to do that. You can also be able to fathom and be able to know a long-term trading signals too, right? So these informations are very important to every financial analyst or to every trader. So you as a trader need to work on being able to, you know, evaluate and be able to find out the key things you need to do to be able to analyze technically, because that is what actually makes you a trader. When there is no fundamentals to drive the market, will you say because there is no fundamental news coming out, no high impact news, you won't be able to trade or be able to harness some opportunities in the market? No. But technically, if you can be able to analyze the price actions, you know, happening on the price charts, you'll be able to know that you can actually get some signals, some trading signals that can foster a very good trading. No, so here we found out that in some cases you find out that traders now do what? Now employ different technical tools to be like to be able to analyze some different price actions by having some indicators, right? So indicators are one of the tools or one of the instruments that aids, you know, analyzing technical analysis, that makes it easier. You know, it makes it easier and simpler for you to be able to have an overview or a look of the market. You understand? So, and with that, you can also be able, with those indicators and those price action, you can be able to know the future price movement. That's why they said with technical analysis, you can be able to generate both the short-term and the long-term trading signals at a go. So there are three basic charts types technical analysts use to evaluate prices. So you can have the one of bar chart, the line chart, and the candlestick chart. So the one that is very, very popular that most traders use is always the candlestick chart. So at the same time, if you can learn candlestick patterns, is actually a very important, because there are some people, when you study the candlestick patterns, you'll be able to determine, you'll be able to know some of the price actions, some of the things that you will see, its interpretation when you are analyzing technically. So I'll just giving you some little bit of expo. So after this class, you can also go on YouTube or go online and be able to make researches on candlestick patterns, you know, looking at it, be able to study it and also know how it works. Or you can choose any indicator of your choice, which can aid as a strategy for you to be able to analyze technically. So now, when you're analyzing technically, when you're doing your technical analysis, there are periods that you, or there are time frames that you need to put into consideration whenever you are doing that, for you to be able to have a better look at that particular instrument, at that particular market, at that point in time, right? So you don't just stick to, okay, you just want to just check what is happening at 1 hour, that's just it. So we have different time frames. So these time frames are called, they are the period within which bars or within which candlesticks formed on the chart, you know. So traders use them to form opinion as to where and what price we do based on that period. So on the MetaTrader 4 time frame, you have the M1, we also have the M30, we have the H1, H4, D1. You understand? So what it means is you can actually check this in hourly. 1 hour, H1 is 1 hour time frame, 4 hours, daily time frame. We have the daily time frame, we have the 30 minutes, we have the monthly, right? So if you want to have an overview of what this particular instrument has been doing for this period of time, you can be able to ascertain that when you are doing your technical analysis. It's always good to have a very good view of the market, you know. For example, if you're analyzing Euro USD, you need to look at, if you decide to, okay, let me even know what's maybe in the morning, as early at 8 a.m. or 7 a.m., you want to trade Euro USD, you can decide to say, okay, let me even know where Euro USD, what Euro USD closed with yesterday. So where do you get to know, have a look about that when you are doing your technical analysis? Is on the daily time frame. That's when you know, okay, that, oh, Euro USD actually closed bullish yesterday. So because it closed bullish yesterday, what actually prompted it to for this particular instrument to close bullish? That's why you can now start making inquiries, checking your, use going to investing.com to be able to have a better understanding of why this particular instrument closed bullish, you know. So on the daily time frame, you have already having an understanding of what happened for that day. So that means yesterday. So on to maybe this particular today, maybe in the morning, you don't want to look at, okay, what is happening, what is the price action like, or what is happening in the candlestick price, what is happening in the market as at 1 hour, where is the candle as at now in 1 hour time frame, in 4 hours, you know. So you'll be able to have an overview look of what the market is doing at that particular point in time. So whenever you're doing your technical analysis, always try to look at all this time frame, depending on what you are actually, what you want to achieve at that particular point in time. So here, we, like I said, we are very used to the most popular type that most traders normally use on their chart to trade is the candlestick charts. So this is what candlestick charts looks like, right? So that's the one we have. Most people are very is the most popular one that is being used by traders. So candlestick charts are used by traders to determine the possible price movement. So this candlestick that you're seeing, the one in green, the one in red, they are all there to just show the price action, the price movement, what is currently happening in the market, right? To be able to, it's also going to show you, okay, if there is a very if the market is highly, you know, liquid at that particular point in time, or highly volatile at that particular point in time. So that's what, with the help of the candlestick packer, you'll be able to know what is actually happening in that market at that particular point in time. So it's candlesticks actually shows 4 price points: the open, the close, the high, and the low. So these are the things you actually look out for in the candlestick pattern. So throughout the period of time, the trader specify. So candlestick pattern on the chart are the most widely used, like I've said before. So this is the most popular chart that people use to trade, most traders use to trade, you know. So let's get to work. So like I said, it has 4 basic price points of interest to traders. So we have the open price, we have the high price, we have the low price, we have the close price. So of all these price level, the close price is the most important to every technical analyst. So you as a trader should always be on the watch out, on the lookout for the close price. So looking at this bullish candle here, you find that in every bullish candle, see where we have it opens here. This is where the price opens. This is the open price, and this is the closing what? Price. It opens here, and from the support, it opens. This is the open price, and this is where it closes. So this is the high price, and this is what we call the low price. So at the wick, these are the kind of this low price is at the wick of the candlestick. So this is the wick. This is called the wick. This thing is called the wick. So for the price to have opened here and be able to close here, it didn't close at the high price. So it closed before the wick of the candle at here. So that's how you know this actually signal how to know the bullish. This is called a bullish candle. So that's how to determine the open price and close price of a bullish candle. So it always opens, price always opens at kind of the support or at the bottom part of the candle. So likewise, this bearish candle here, that's the one on red, you know. So its price opens here at this point and it closes what? Here. So same thing, the high price. So this is also the wick, that's called the lower shadow and the upper shadow. So this is the wick of the candle, right? So this is the main body. So that's how whenever a candle opens, so this green candle always represents the buy or the bullish candle, while the red one represents the bearish candle. So now, in this candlestick pattern, remember, this without take us to be able to have a better understanding on this strategy called support and resistance. So like I said, you can study the candlestick pattern and be able to have a better understanding. It's a strategy on its own, you know, for anyone who wants to trade and you want to have a better understanding. There are different strategies, different indicators you can use to help you to have a soft landing when you are doing your technical analysis. And one of them is candlestick patterns. You can study the candlestick pattern, and now you can also study the support and the resistance. So we have the support and resistance zones whenever, if you are looking at the candlestick strategy. All right. So before we proceed to discuss the candlestick strategy, let's look at the concept of what? Support and resistance. So whenever you are learning about candlesticks, charts, price charts, it's always very important you take cognizant of this particular concept, support and what? Resistance. This is very, very important because we cannot trade candlestick in isolation until we see their formation around support and what? Resistance zones. So now, let's look at resistance zone. So resistance zones are areas on the chart that tends to prevent price from appreciating further. So in other words, they act like a ceiling. So for example, now I like using a layman's or a ritual kind of understanding of what this particular resistance zone is talking about. You know, the ceiling of a house. You look at the ceiling of a house. So when you throw, maybe you throw a ball up to the ceiling, it will hit the ceiling and it will bounce back down, right? So when you hit it again, it will hit the ceiling and it will do what? Bounce back on the ground. So what it means is that moment that it is hitting that particular ceiling, that particular ceiling is serving as what? A resistance for that ball to be able to break through that ceiling, you know, because the ball is not that strong enough to be able to break that particular ceiling, that resistance to be able to go. So that particular zone, that a rejection zone, or that particular place is what we call resistance zone. So there are some times in the charts where you are analyzing or you are looking at the charts or you are trading, you find out that there is this particular zone whenever the candles, whenever price gets to that point, it tends to do what? It bounces back, it retraces back down. So in different, it has happened, maybe it has happened last month or for the past how many weeks. Whenever price gets to that particular resistance, it will do what? It will bounce back down. So it means that looking at that zone, it's called, that particular zone is what we call what? The resistance zone. It's called the resistance zone. So that's like a rejection zone. You can also use that word, but it's called what? Resistance. So whenever you look at that particular resistance, technical analysts always look out to do what? To sell on that particular instrument. They always look out to do what? To sell. So what it means is that because that rejection has happened, it's always very obvious when it gets to that particular resistance, technically, it's going to do what? Bounce down. So now that takes us to what? The support zone. So this is an area on the chart that also tends to prevent price from depreciating further. So in other words, they act like what? The foundation for the price to breathe and also move what? Back up. So for example, now, like down, the floor, you keep, when something hits maybe like the foundation of the floor. So sometimes when there are some things where if you hit it on the ground, so because it's just like the support of it, it will tend to, like, there is nothing to be able to, it will hinder. You throw something, it cannot break down to, you know, possibly go down. So but something is already wedging it, like the ground or anything. So that's kind of saying that this particular thing is has gotten to that point that it cannot go further. So that thing is sounding is like what? Is support. When you are holding on to something or you are using something to wedge something, even if they throw that, you are using it to hold it, to wedge it, because that thing is already there to hold. It's like serving as a support. So that support, there is nothing, unless that thing is being removed, that what you are putting there will now fall out. So that's what we call the resistance zone and the support zone. So here, technical analysts, every trader always look out to do what? To buy. So that's why you always say that people sell at resistance and buy at the support. So it's always risky for you to say you're buying at resistance. No. So most of the time, so that's where that particular ideology came out from. So looking furthermore in support and resistance. So there is something that we call the verified resistance, a verified support and resistance, and there's something we call a proven support and what? Resistance. So as a trader, it's always very good that you'll be able to look out for these particular zones. It is very, very important. We have support and resistance, will I say indicator or something. So you can also, if you have that on your system, that's very good. So you can as well ask for that if you don't have that from your account managers and request for that, right? So what I'm trying to say is that we have what we call fixed support and what? Resistance. So whenever a particular zone, like I said, it has, when a particular zone is being tested twice, like a price gets to that particular zone, that particular resistance, it goes back. And it has happened maybe in every 2 weeks. Whenever price gets to that point, it comes down. And that particular zone has been tested twice and it still holds, and it's that particular, it still happens. That's where you now see that this particular zone, you can now say that this particular zone is a verified resistance because it has been tested. That particular price action, the candlestick have tested that particular zone 2 times, have tested it twice in different occasions. That's the reason why they say that if you are looking at technical analysis, it always helps you to have a broader look of what has been happening in the past in the market to be able to predict what will happen next. So you have looked at this particular candlestick pattern, and further that this particular candlestick price have tested this zone for some time, this particular week or this particular one, and it has also happened this particular zone. So now you realize, okay, this is actually what? A verified support or a resistance. So it has happened 2 times to be able to have that this particular zone is a verified. So, but when the test count continues to rise, maybe it has risen to up to 4 times. So it has it has tested once, twice, thrice, and going to 4 times, right? What it means is that hello, Uche. I'm in class. I'll call you back.
Are you still in the office?
Yes.
Okay, no, let me chat you up on WhatsApp.
All right. Can you hear me? Okay, so okay, if you can hear me, please, can I see to be sure that you can hear me? All right, so like I was saying, okay, all right. So if it has happened, if you are that particular, the same thing continues and probably test that particular resistance zone or the support zone for more than two times, right? It will now be called what? A proven support and resistance. So try and know the difference between that, right? So now we also have what we call a dynamic support and resistance. So the one that we explained before, the one that we talked about before is a fixed support and resistance. So, but this particular one is called the dynamic support and resistance. So here, it can be this particular one, it moves and bounces around the chart with prices. So most common example is using a moving average as a support and resistance. You know, when you plot a moving average indicator or the strategy, or you want to use trend lines, you know, some of these particular indicators, when you place them on the chart, can actually serve or act as a resistance or as a support for you to be able to have your entry in the market. So that's the reason why it's called dynamic, because it kind of changes, you know. So, but the fixed support and resistance software that automatically plot and draw the zones on the chart, they are also widely what? That's why I said, if you need it, if you don't have it, you can ask your account manager for that. So look at the typical example of what I am talking about. All right. So, okay, so look at what we are. This is a typical example of verified resistance or verified support. And also, so let's look at it. So you see, this is a trade chart on DE30, daily time frame. So you are looking at it at a daily time frame. So that's why it's like that. So it has gotten to this particular resistance. It happened on this particular time. And here it's still trying to do what? It's retesting this particular what? This particular zone for the second time. That is why you have here, it's called what? A verified what? Resistance, because it has tested this particular zone. Whenever it gets to this particular zone, price tend to do what? Reverse back. So look at it. It got to this particular zone and the price, there was a rejection here. It was rejected and it started selling. Same thing also do what? Happened here. It got to this particular, look at the wick of this particular candle, there was a rejection and it do what? It started retracing back. So history kind of repeated itself here. So imagine it happened somewhere here happens somewhere here, happens somewhere, happen maybe up to 4 times, it will no longer be a what? It will no longer be a verified resistance. It will not be what? A proven what? Resistance, because it's a resistance that's already been proven that, okay, this, but whenever price gets to this particular zone, there must be a rejection, unless there is a strong fundamental or high impact news that is coming out on that day that can be able to do what? To frustrate the thing to be able to break that particular, a force to break that particular resistance to create another higher high. You understand? So that's just it. So look at this particular place, this particular support zone here. There was a rejection here and price went up. It happened here twice, happened there thrice. That's why you have what? A proven what? Support. So as a trader, it's always good to, especially when you are trading, trading with candlestick pattern, especially on your chart, technical analysis, always be on the watch out for what? Support and resistance. You know, it is very, very, very important. I don't know how else to explain how important it is to work with support and resistance. So please, you can decide to make more researches and have a better understanding of what support and resistance look like. And if you don't have it on your chart, you can consult your account manager to assist you on that. So now this is also a support and resistance, the dynamic, you know. So look at here is a moving average, right? So this moving average now is kind of serving as a what? A resistance here. If you break this resistance, price continue, and also like what? A support. So that's what it means. Like, if you can use this moving average, that when price breaks this particular support zone, this moving average here automatically is already serving as what? A support zone here, and also as a what? A resistance zone here. So that's what the typical example of what I just explained to us, right? So that's just basically what you need to actually know when you are doing your technical analysis, especially with support and resistance. So I think on this slide is just how, for whoever, if you're trading with your an Android phone, how to be able to draw a moving average, you know, to place the moving average on your phone and be able to have, if you want to use the indicator, moving average indicator on your phone, and be able to ascertain the dynamics on how to go about it, as how it forms the support and resistance on it. Oh God, I believe with that I've actually, you know, have explained better of how you'll be able to use the support and resistance when you are doing your technical analysis. So now this is an illustration of a trend line. So this is how a trend line is, you know. So what you on your computer, you just, this is how you can be able to, you know, draw it from, it's always to draw at least 2 points, to join at least 2 points on the chart. So the more the points connect, the better, right? So some people can say, to use trend lines if that's how you want to do that. So I believe when you contact your account managers for a better understanding, like want to install it, make a use, but it's always good if you can study the candlestick pattern, also taking cognizance of support and what resistance. In short, in any technical analysis, support and resistance is key. If you can have a better understanding on that and the other price actions through the candlestick patterns, you will be good to go, you know. So here is a support and resistance trading plan. So you'll be able to identify the instrument you want to trade. So before you execute a trade, try and identify the trend to technically to establish market direction. So it's always good to note the trend of a particular instrument, you know. So how do you do that? You be able to, you can use the trend line. You can as well probably plot a 200 period moving average to be able to determine that, so there's different ways you can be able to ascertain the trend of a particular instrument for a very long time, So that's it. So the other one, you take notes of fundamental events for the day. Very important. Always, before you analyze, like I said, different ways to be able to analyze the market: fundamental analysis, sentimental analysis, and what technical analysis. So you have to check to go to Forest Factory and be able to check the economic calendar to know if there is any high impact news coming out for that day. There's any fundamental events coming out for that day or that week. So that will also make you to have a better look in the market. So if there is no need, even if you are going to ascertain your technical, and then just for you to be able to have a better understanding, okay, look at what is going to happen, just make your entries and that's it. But if there is no fundamental event for that day or that week, that is where your technical analysis comes into play full time, right? So that's just it. So the market can actually, if the market is bullish, if it's a bullish market that you're looking at, you now look at, okay, if price is at support, if price is at support. So these are the things you look out for. You also can see if the market is consolidating or sideways. Consolidation market means the market has been on retracement, so it has been going up and down. It means that there is an indecision in the market. So at that particular time, the market is not volatile enough and is actually trying to gain momentum, either on that consolidation part to wait for a breakout. On that, once there is a consolidation happening, I always tell my clients, or talk to them, if the market is consolidating and consolidating for a while, there is an indicator that you can use to measure the volatility and the momentum of a price in the market. That is Bollinger Bands, right? So that particular indicator can give you an insight to be able to know when a breakout will also happen. So the longer the retracements, the higher the breakouts. So that's what Bollinger Band can actually do for you. So if it's a bearish market, so you also try to ask yourself, is the price at a resistance level? So whenever they say a bullish market, it means the market is buying. They say bearish, means it's selling. So if it's on a sell market, so you try to have a closer look at the prices at the resistance level. You understand? So you either sell or you do what? Wait. So these are a pictorial kind of a way you can actually analyze your markets and be able to know, okay, you have done your best in this particular technical analysis, and there is no way you will try to analyze your trades like this that you won't come out successfully. So remember, whenever for your technical analysis to be very fast, and also to be able to have a better overview, have a very good look at the market, different strategies are needed, right? Some trading strategies are needed, which I said, one of them is the candlestick pattern, which we just discussed now, which is the key. If you're using a candlestick to trade, candlestick charts, so you need to learn the candlestick pattern, support and resistance. You have the moving average, you have the trend lines, we have some other indicators that you can decide to learn. So learning a particular strategy means a particular indicator to be able to assist you or help you in analyzing. It makes you to be able to have, if something that you have been looking at, with the help of an indicator, it will be very fast. It makes it faster and it makes it easier for you to be able to have a closer look at the market and be able to make your entries. So that's just it. So I would like to, so we also have fresh pips, we we have hybrid. So everything, all these indicators that I've just mentioned. So look out for, we have different packages here in Rally Trade. So different packages have some of these softwares or indicators that comes with them, right? So we have the one we call breakout promise, we have the Fibonacci retracements. So that one, you can use that one to trace some of the retracements that are also happening in the markets. We have the RSI, we have different, name them. But if you're on the VIP package, the package of 1 million naira and above, you're trading that. That's when you can ask your account managers for that particular software. You are qualified to have such indicators. So likewise, some other packages like the platinum, the gold. So whichever package that you are, you can as well request for the indicators attached to that particular. So we have a whole lot of indicators, and we have a lot of them that you can actually make some researches on the net and have a better understanding. So I don't know. And that brings us to the end of the class for today. Like, can you hear me?
Yes, I can hear you.
So I think we need to, sorry, I think kind of, I don't even know. So let's try and take some of the questions that have been asked.
How can fundamental?
Okay, Archibong, you're asking how can fundamental impact news be interpreted and applied in the market? So I would like you to be in this class tomorrow. Tomorrow is going to be a topic class on fundamental analysis. So be in that class same time tomorrow. What happened if the price break through the resistance zone and support zone? So it means that a particular something must have prompted it. If you listen to the class of tomorrow, you understand it, but it means that a higher impact news is already out. So that means that particular news has probably shown when the news come out from the data that it will be a very bullish market. So that's when it needs a very strong fundamentals that can come out to be able to break that particular resistance to create another higher high, right? So that's it.
Let me ask Joshua to mute. I don't know whether you can hear me. Please, can you ask him to talk?
Joshua, can you hear me? Are you still there?
Hello. Hello, yes, I can hear you. Hello. Hello.